they're still asking 4 and 5 caps when interest rates are 6. I don't want to go into a deal right now in this part of the market cycle with negative leverage. I don't want to do that. That's the fear that I see. If I'm going to buy an old asset right now and take all the risk, as rents, believe it or not, are either flatlining or they're dropping in some markets, I don't want to catch a falling knife and say, okay, I'm getting this deal. I'm going to underwrite this deal for the next 2 to 3 years. Be very careful of how you're underwriting rents right now, and also expenses. Expenses have jumped up, but I don't see expenses slowing down over the next 12 to 24 months. So don't go in with these rosy colored glasses and say, hey, I'm going to get 5% rent growth the next 3 years and my expenses are going to be flatlined. Just be very careful. All that being said, I still think, Mike, there is a great opportunity in the next 12 months with a lot of this debt that's resetting, a lot of these sellers that have to get out of these assets, a lot of these, LPs, they're pushing the deals, right? It's constantly pushing, kicking the can. Those deals sooner or later are going to have to matriculate. And I think that's where the opportunity is in the next 12 to 24 months.
I hear you. I am completely in agreement with your point of view. But what are you seeing? What are you able to actually buy? Because you have an issue here of, I mean, we definitely need to have a positive spread between the cap rate and the interest rate. So the interest rates are at the elevated level. So you got to get really meaningfully higher
Yes.
cap rates. Otherwise, you're not getting a deal at all.
Yes.
So what kind of deals are you seeing in the markets that you're operating? And you're still seeing downward pressure on rental rates and occupancy because of the
Yes.
oversupply?
And,
Right. So
and,
if
and
you're buying existing, you got to get a really good deal. Well, what does a really good deal look like? Like,
a
are you
great
buying
deal.
anything now? What do you like today?
For us, we're very simple when we underwrite because we're cash flow investors. We want to buy in profit per unit. We want to buy cash on cash. So if we can look at a deal, very simple, the underwriting. If you're buying an asset for $100,000 a door, we'd like to see $1,000 in rents on that asset. I mean, that's the reality. It's so
Still
simple.
1% ratio.
1%, that makes a deal work. And then with these interest rates, then when rates drop, you can refi, great. But the problem is, so this Cardinal deal right now, Cardinal deals are pretty crappy deals. They're smaller properties, smaller builds, 300 square feet, 600 square feet units. They get an amazing price per rent on the square footage of those things. But even those, like, they want like $100,000 a unit for a property built in the 90s that is, it's suspect. You got to do roofs. There's not much meat on the bone there. So if you're going to buy an asset like that, you have to understand what your exit strategy is. If you're looking to buy that deal as a syndicator and flip out in the next 3 years because you think you're going to catch a wave, that's not the kind of asset you need to be doing it. Now, for us, if we can get a lower price point, maybe in the mid 70s per door, and we have, like, let's say $900 to $1,000 in rents, that makes sense to us, because we can hold it long term, we can refinance some of that capital out, and we can continue to operate that asset. But to your point, you need to be careful right now, because in a lot of the markets, rents are flat. And in a lot of the markets, in my opinion, rents are actually dropping and occupancy is dropping. So when you're trying to underwrite, it's so difficult. I've looked at, I don't know, maybe 10 T12s and 10 rent rolls in the last 2 to 3 weeks. Everyone's occupancy, the highest I've seen is 91%. I've seen a lot of delinquencies on these rent rolls, and I'm seeing that occupancy is dropping. So just be very careful, because that's the reality right now. And that's, I think, the storm that's going on right now. And if you can hold on and you can find the motivated in a seller, that's what you're looking for. But for us, if we can buy a newer asset, anything newer, our last deal we did in April was a 2024 build. We bought it from a builder. We had bought 2 previous assets from him. 2024 build, we paid $180,000 a unit. 3-bedroom, 2.5 bath townhomes, 2-bedroom, 2-bath townhomes. Rents are around $1,700 a month. That deal works, because you walk into that deal at 6%. You're getting interest only for 2 years from a credit union. Right? Rents, I think, at the end of 2 years are probably going to get to $1,800. They're going to get to the 1% rule, but it's such a great asset in a great market where there is rent growth. Actually, there's job growth also there in that market. It's a little bit outside of Knoxville, and the CapEx requirements are none. It's a brand new asset. It's built really well. It's something where, hey, if I'm going to own this for the next 10, 15 years, it fits really well in my legacy thinking as well. And it fits well there because we already own 2 other assets. So we'll be able to strengthen our position in that market as well.